we fix nothing, and that means when the recession hits, the problems will be much worse, unfortunately, much worse than they were in 2008.
Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping on every order, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 40,000 new customers who have recently made the switch to SD Bullion. Why pay more?
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and with us today is Michael Pento from Pento Portfolio Strategies. Michael, thank you so much for joining us today.
Thanks so much for having me on, Elijah.
All right, I'd first like to discuss the stock market and also the economy. You are predicting a stock market crash and recession to begin this December. Can you explain a little bit about this and the reasoning behind how you got to that forecast?
Well, how's that for precision? I can actually tell you the month. Well, I got to tell you, Elijah, we're all in this guessing game and there's only one God, but I can tell you my rationale behind saying that I believe market chaos and recession/depression is very likely to commence around the end of 2017 or very early in 2018. And I look at the yield curve for that conclusion. If you look at the spread between the 10-year note and the Fed funds rate and the 2-year note, if you look at that spread, it looks to me, if the trajectory of the 10-year note continues to decline, and we're definitely in a bear market in yields on the 10-year note, we hit 2.11 yesterday, we bounced to 2.16 as of this recorded interview today. And you look at the Fed funds rate, which is now at a rate between 1 and 1.25%. If the Fed continues on its current rate hiking trajectory on the Fed funds rate, and the current trajectory of the 10-year note continues to decline at its current pace, we'll probably invert the 2-10 spread. Just to qualify, the 2-year note usually trades about 30 basis points above the Fed funds rate. So the Fed funds rate is raised 2 more times, and you add 30 basis points for the 2-year note, the 2-10 spread should flatten out and invert around 2% around the end of 2017 or the very early start of 2018. And why is that so important? Well, an inverted yield curve has always presaged a recession. The last 2 times it inverted, we had a huge drop in the major averages. In 2000, we had an 80% drop in the NASDAQ, and in 2006 and 2007, when the yield curve inverted, precipitated a 50% drop in the S&P, a 35% drop in home sales. And now we have a triumvirate of bubbles: bonds, stocks, and real estate. And I think that the chaos can begin as that yield curve inverts. And you say to me, well, why are you so fixated on the yield curve? And I'll tell you that when the yield curve flattens out and inverts, not only do you get a recession, but the rationale behind that is that banks stop lending money. And when that rocket fuel, that monetary rocket fuel, gets cut off, asset bubbles plummet, and that causes a recession. So that's why I gave you that date. It's all subject to very, very much theory and conjecture, but that's my best guess as to why people should be very much afraid and myopically focused on that yield curve inversion.
Right. And you've talked about before how this really inversion of the yield curve, when short-term rates yield more than longer-term rates. In the past, when this has happened, it's predicted the last 7 recessions going back to the late 1960s. So can you expand a little bit on this and why it spells disaster for the economy?
Well, again, so if you look at what's happening is that we've had a huge increase in asset prices, which is the Fed's theory of a trickle-down asset price economy, is that you can rescue banks' balance sheets by taking all their bad debt off of their books. You can increase the amount of excess reserves that they have willing to lend, but they don't lend that money out because we're a debt-disabled economy. So instead of making loans to consumers and businesses, what banks are doing is they're buying more government debt. and buying stocks. And that's how the money supply increases. It's a very unproductive way of growing the money supply because there's no GDP growth associated with just buying assets. So you have asset bubbles that are used to create ersatz or fictitious wealth. And when the money supply gets cut off, because the bank will never make a loan if they're paying more on the deposit than they are going to collect on the loan, their asset. So when money supply gets cut off, these asset bubbles burst. And the asset bubbles, again, the triumvirate is a record bubble in bonds, record stock valuations, and very close, if not all-time record highs in the real estate market. And when the money supply gets cut off, what's going to happen is you will find yourself in a brutal recession, and one that the Fed will find very, very difficult to extricate itself from, because we're only going to have about 200 basis points at that time of interest rate reduction. And we will have, for the most part, the $4.5 trillion balance sheet intact. So the Fed is very reluctant to expand that balance sheet, but they're going to have to do it, in my opinion, once this recession comes, because if you reduce borrowing costs by just 200 basis points, 2%, that is not going to be enough to pull the economy out of its tailspin, out of its nosedive. So you're looking at a huge increase in the size of the Fed's balance sheet going forward, probably in 2018, and the adoption of helicopter money sometime in that time frame.
Right. So basically you're saying that interest rates are already so low that they can't lower them that much more. And we already have an over-leveraged Fed balance sheet. So when they start more money printing, then it'll just become more and more over-leveraged. So what will this cause in the economy? The Fed is going to, continue with its stimulus. The Fed's balance sheet is just going to become more and more over-leveraged. What kind of impact will this have on the economy then?
Well, I could tell you one thing, and I forgot to mention, that household debt is at a record $12.7 trillion. The public debt has doubled since 2008. The corporate debt has surged. So you look at the over-leveraged balance sheets and the debt-disabled condition of the United States, and you can throw in China, Japan, and Europe in there too. So the balance sheets that rescued the economy from 2008, the balance sheets of central banks and governments, are now completely saturated with debt. So you could say, well, in the next recession, deficits could be, according to the CBO, they'll be starting at the baseline deficit will be close to $1 trillion. And then you add to that a recession, which could bring bring the amount of debt deficits to 1.4 trillion in addition to the trillion. So you look at a 2.4 trillion. And then you look at the interest expense, which is for every 1% rise in the average interest rate on the debt, you get a $200 billion increase in debt service payments. And then if you throw in any tax cuts that could come, you're looking at deficits, annual deficits that could be close to $3 trillion per annum easily. And you have to ask yourself, who's going to buy all this debt? So in my opinion, I think Janet Yellen, she had a FOMC announcement yesterday. She raised rates again, as everybody's aware. I mean, I don't know what planet she's from. She's myopically focused on a Phillips curve effect, and she's myopically focused on the U3 unemployment rate. And in her mind, she's convinced that inflation, and I have to say, parenthetically speaking, I cannot believe that these Keynesian liberal academics are so convinced that the progenitor of inflation is too many people working. I mean, how laughable and asinine is that? They should know where inflation comes from because it comes from them. They are the progenitors of inflation. Inflation comes from excess money supply growth in relation to goods and services in the economy that are available for purchase. So they are the cause of inflation. But the Fed is hiking rates because they're worried about some hyperinflationary breakout coming from a U3 unemployment rate, which is never going to happen. There is a tremendous amount of slack in the labor market to start with. And inflation doesn't come from, again, inflation does not come from too many people working. It comes from excess money creation, a huge increase in the money supply. And the base money supply, if you look at the size of the Fed's balance sheet, is incredibly massive at this moment in time. And I believe in response to the next recession, because we're going to have massive debt and deficits, because balance sheets are already strained on the public and private sector, and in the Federal Reserve's balance sheet is also strained, what you're going to see is something called helicopter money, which is the Federal Reserve will further imperil its balance sheet by creating money and directly sending it to the public. And they do that by bypassing or circumventing the private banking system and directly send transfer payments through the Treasury or directly to the public. That's what I think is going to happen in response to this next recession/depression, which is headed quickly down the pike. It's going to be caused by the Federal Reserve, as all recessions are. And I think it could happen as early as December 2017.
Now, moving our focus over to China, you've recently written that China is running a fairy tale economy being propped up by money creation. So it seems like kind of a similar thing that's happening in the United States and you see will continue to happen in the United States. And over there in China, you say China cannot continue this indefinitely, and China is heading towards a currency crisis. So can you expand on this, and how do you think this over in China could impact us over here in the United States?
Well, China was responsible for about 1/3 of the global growth since 2008, and everybody knows how they did this. They massively increased the amount of debt in China. I mean, their debt is growing at 4 times the rate of GDP growth. It takes $4 from $1 of GDP growth, and the reason for that is because their debt is non-productive debt. They're not loaning money. Real savings is not being loaned to the private sector to build viable, productive assets. They're building empty cities. We all know about that. Now, the problem I see in China is that it's not only debt, and I don't want to get into the specifics of the debt because everybody knows about the debt in China. Which I will say to you is the problem in China is going to be become manifest through their currency. And you could see what they're doing. They're doing desperate measures to keep that currency, the yuan, from completely falling off a cliff. And they had been selling their currency reserves to try to prop up the yuan. And when that wasn't enough, the government of China is now actually making up the currency rate. So they have something deployed called the counter-cyclical variable. In other words, what they're saying to you, they find it very hard to control the value of the yuan offshore. The yuan trades in Hong Kong as well as in Shanghai and in Beijing. So they find it hard to control that rate, not only through direct targeting and direct currency manipulation, but now they just they've told everybody that they are going to basically, the term they use is counter-cyclical variable, but they are actually making up the exchange rate. In other words, to put that in stock terms, let's say you want to short a stock that's $10 and it goes to $9, and then the next day the government of China is telling you that they will now accept this stock at $10 a share. They put the price back at $10. So why would how do you short that stock? They've actually also dramatically raised margin rates on yuan-based loans. So no one can borrow the yuan anymore for the currency trade. So what they're trying to do is manipulate their currency and manipulate their economy and manipulate their GDP. And they're doing a fantastic job at manipulating their market too. But the currency will be the Achilles heel. That will weaken. That will eventually become extricated from their manipulations, and that's the real danger. Watch the yuan-dollar relationship, and if the yuan starts to really tumble, that could bring chaos to global markets. And that, again, since China is responsible for 30% of global growth, new growth in the economy, globally speaking, since 2008, that would really hurt emerging markets. And all of the developed world as well.
Now, moving to precious metals, you've said that the stock market, you see, falling by the end of the year or early next year. Where do you see precious metals leading in the near future?
Well, right now, I had thought that, and I thought mistakenly, to be honest with you, I had thought and correctly thought that the weakness in economic data and the weakness in inflation data would cause Janet Yellen to pause. I thought that she was going to come out yesterday after the Wednesday FOMC announcement and say, we raised rates by a quarter point, but we are deferring the draining of our balance sheet, the selling of our mortgage-backed securities and treasuries. We're deferring that. And risks have now moved to deflation or disinflation, and we may not raise rates for the rest of this year. Some kind of language. I didn't expect her to be that dovish, but something like that. And she was not. Now, you could say maybe that Janet Yellen hates Donald Trump and she hates Republicans. She's leaving anyway, and she's trying to sabotage the administration. Or you could say that maybe she really understands that asset bubbles must fall, stocks, bonds, and real estate. They're becoming dangerously disconnected from underlying economic growth. Or you could say that Janet Yellen really believes her own BS. She really believes that inflation is right around the corner, looking at that unemployment rate, U3 unemployment rate, and that she must hike rates into what I believe is a recession/depression. So short term, that's not good for gold. Gold will have a tremendous watershed rally, a historic rally, an epic rally beginning sometime in the next few quarters into 2018 for sure, as this recession becomes so blatantly manifest that even Janet Yellen has to reverse course, and that will really submarine the dollar, especially as the ECB starts to extricate itself from quantitative easing, and also the Bank of England starts raising rates. But until then, I think it's an accumulation phase. If you look at gold mining shares, they are almost down to their low for the year. So this is a great time to start accumulating gold if you have no position, and get ready. What I would say is an epic, historic rally in gold after the Fed goes into neutral. They will shift their monetary policy into neutral, and the catalyst for that, very easy to spot. One of these two things has to happen. The non-farm payroll report below 50,000, or you see the stock market drop more than 20%, the major averages. Either one of those things will shift her into neutral immediately. So until one of the two things happen, which is inevitable to happen, look for the Fed to gradually raise interest rates and maybe even to start draining their balance sheet. Yeah, I have to tell you, I think the data is going to be so weak. I think that non-farm payroll report is going to be so weak. And I say that because the household survey always leads the establishment survey, and that turned negative 223,000 in the May report. So if that trend continues, then I don't think we ever get to worry about her draining the balance sheet. I think she shifts into neutral before the end of the year. But that's not enough. And that's why I said that the recession is coming, because what the only thing that can prevent this recession, and maybe even not even a recession, maybe a depression, would be a massive amount of helicopter money immediately. And that would probably be not so much beneficial to the economy. It would just lead to an exacerbation of stagflation. I'm predicting this is where we're ultimately headed in the economy, is an unprecedented battle with stagflation. And I say that if a Federal Reserve resorts to helicopter money, sending money directly to individuals, circumventing the private banking system, and sending money directly to individuals, that is a recipe for hyperinflation and stagflation like we have never seen before in this country.
Well, Michael Pento, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Well, my website is pentoport.com, and my email address is mpento@pentoport.com. You can also call the office here. I promise you we won't bite you. It's 732-772-9500. The time is now to prepare for a chaos in markets, currency markets, bond markets, equity markets, real estate markets. It's coming. The Fed has done nothing since 2008 but prolonged and exacerbated deferred the collapse and exacerbated the degree of that decline. Because what we've done is we've taken, don't forget, what we've done is we've taken the assets, the impaired assets from banks, put them onto the balance sheet of the public. And now we have, as a result of that, insolvent sovereign governments around the world, insolvent Federal Reserve balance sheets and central bank balance sheets around the world. We have a debt-disabled economy in the United States and around the world. And that is because rather than allowing these assets to collapse and allowing for a recession in 2008 to consummate, we went about fixing the problem by using artificial means. And by that I mean we have artificially put interest rates for below 1% for 100 months, and we've taken out on an extra $10 trillion in government debt. And in fact, debt as a percentage of GDP, total debt in the United States is now 350%. That is an all-time record high. So we fixed nothing, and that means when the recession hits, the problems will be much worse, unfortunately, much worse than they were in 2008.
Michael Pento, once again, thank you so much for joining us today.
Thanks for having me on, Elijah.